feelings are kind of mirrored by a great number of our clients, actually. It's this year, I mean, taking aside some of the recent wobbles, yeah, this has actually been a good year.
It's been a great year.
Gold has had a great run. Gilts have had a great run if you look at kind of January down through to sort of end of October. S&P 500's obviously had a good run. Even the FTSE 100, even our domestic markets had periods of kind of strong performance. But actually talking to our clients, and some of this is the domestic overlay of the budget, which I'm sure we'll get to, because there is sort of political and policy uncertainty, which does impact how people want to allocate their cash, not necessarily on a regional level, but in terms of, understanding their personal household cash flow and how that might be impacted. But this market, because it has come with so much volatility, I mean, volatility index back up to sort of 24 today, there's a lot of fear. And we see that with the animal spirits. We see that with what's happened over the last few days. Just the idea that the Fed actually might not cut, that there's moved from such a certainty in December to now a 50%, market's gone wild.
Bears make sense, bulls make money. We know that. The wall of worry, all those lovely adages that we've all known over our careers as well. It's been right to be in the market until the last couple of weeks. What now? Is the feeling that this is a good entry point, and the retail investors will be saying, yeah, because they're the ones who are buying every entry point and cleaned up doing so as well? Or actually, is it a time in a broader cycle to be more circumspect?
I sent my notes to your producer yesterday before Jamie Dimons came out and said almost the exact same thing, so I want it on record that I said it before Jamie. But we do think that this is an AI-specific pullback. We don't think this is the beginning of the bear market. We do think...
the Dow Transports is in correction territory. The Russell 2K is very close to it.
But in terms of, is this the beginning of the end? The big pullback that we are sort of due for in terms of just market timing. We are overdue a major global market correction. We don't think this is that, not least because actually if you look at valuations outside of the US, there's still quite a lot of areas where such negative news is already priced in, especially in Europe, especially in the UK. But actually, we do think this is a sector-specific thing. Now, not to sort of contradict myself, but sector-specific things can obviously cause global market worries. We've seen that. But in terms of does this become a prolonged period of the next global financial crisis, or even the next Q4 2018, where markets sold off considerably because of tweets of Donald Trump to Xi at the time, although they seem to be on slightly better terms now. Actually, we think this is an opportunity for our clients and for investors to have a look at their portfolios and rebalance. Because even taking into consideration this week, most people have had a really good run, even in AI stocks. And we do think, and we see this in our clients' portfolios, there is an over-concentration in what people have been buying over the last 5 years. And now is a really good time to say, actually, look, there will be more market jitters, and the best defense against market jitters is diversification, and actually thinking about, have I got too much risk on the table? Is this a time to be geographically diversified? Gilts are still paying really good yields. You hold a gilt in a tax-efficient account, you're paying no tax on that. So actually be a bit clever about what is available to you in terms of tax efficiency and what diverse asset classes that you can hold, because, actually holding a UK government bond at sort of, 4.5%, is pretty good